Welcome to the New Jersey Bank Marketing Association's quarterly program. In this podcast, we'll hear a presentation on the New Jersey Bankers Association from NJBA President and CEO John McWeeney. Now let's go to the lectern where Jane Gore of Amboy Bank will introduce the program.
Thank you. I think we'll get started again for our second speaker. That was quite a lot of information that Dr. Seneca gave us. I'm still thinking about it, but we need to change our mind and change our brain and go on. Our second speaker is John McWeeney. He's President and CEO of New Jersey Bankers Association. You joined them in April and spent 28 of the prior years as executive with Bank of America and its predecessor fleet, and I'm sure like the rest of us, maybe a few others along the way. While you were at Bank of America, you were market president in the Southern region and the regional director of Small Business Services. Are you still a member with the John Morris Group? I meant to ask you. The risk assessment group, you still do that? And that always makes us nervous when all the compliance people come by. But anyway, I want to thank you very much, and I'm sure John will advocate the New Jersey Banking Association. John.
Well, thank you very much, Jane, and good morning, everybody. And can you hear me okay in the back? Good. It's a pleasure to be here this morning. I feel it's very appropriate in the sense that New Jersey Bankers Association has an affiliation with the New Jersey Bank Marketing Network, and I was just learning a little bit about the history of it. So it's one that we want to continue, and as I've said to a few of you, as we go forward, if we can do more things together, we'd certainly look forward to doing that. And I know a number of you who are with banks here in the room are members of New Jersey Bankers Association, so I'm happy to see you here. And some of you are probably members of the New Jersey League of Community Bankers, some of the savings banks colleagues we have here, and you should know we have a very strong partnership with them. So, pleasure to be here. I know that Peter Crowley is following me on the program today, and Peter and I had the opportunity to work together a few years ago at Fleet Bank when we were both in the professional services area, so I'm looking forward to his comments, and he's also a member of our association. I thought what I would do is just give you a little more background about myself, tell you a little bit about the New Jersey Bankers Association, if you'll permit me just a 3 or 4 minute commercial, and then I'll get into my presentation. But as Jane mentioned, I joined New Jersey Bankers on April 16th of this year. I retired from Bank of America on April 9th of this year, so I had a 1-week retirement and enjoyed that. But my banking career spanned about 28 years, and for me, most of it was with Fleet Bank, which was acquired by Bank of America in 2004. I had the opportunity to work in different geographic markets. I spent 11 years in Rhode Island, about 14 years in New York. I spent time in Long Island, Manhattan, and in Westchester County. And the last part of my career was here in New Jersey. I also worked in a lot of different business lines, and I always enjoyed that because I enjoy the diversity and the variety within banking. And for many of you that are on the marketing side, I would think that's one of the things you like most about your job, because you're not just in one particular line of business. You get to do a lot of different things. But in the early part of my career, I was on the retail side of the bank and running branches and branch systems. Back in the early 90s, working for North Star Bank, which was part of Fleet at that time, I ran their branch system on Long Island in New York City, which was a 80-branch network, so that was a great experience. Spent a lot of time on the small business side, covering that for Fleet in the greater metropolitan New York area. And then the latter part of my career got into some specialized areas like professional services, where Peter Crowley and I worked together. We were in a group that was targeting law firms and accounting firms throughout the Northeast. Had a lot of fun doing that. And until we were merged with Bank of America, and they didn't have a line of business doing that, so we both got different jobs. But also, at the end of my career, spent some time in government banking here in the state of New Jersey, handling the state as a client, the Turnpike Authority, and a lot of school districts and municipalities. So I think I'm the first banker, certainly the first one in a long time, that's been the president of the New Jersey Bankers Association. And to me, it's not that novel an idea, but I think my banking experience has helped me a lot as I've moved into my new position. I'd like to tell you a little bit about our association. We date our history back to 1903, so we've been around for over a century. I know our friends at the League of Community Bankers are celebrating their 100th anniversary this year. So we have a lot of staying power, and I hope under my tenure that we continue to survive and prosper. We have 68 member banks today. Our membership is very diverse. We have large banks such as Bank of America, Wachovia, PNC, JP Morgan Chase, TD Bank North are all members. But most of our membership really consists of community banks. And the vast majority would be community banks that have assets of less than $1 billion. The one thing that all of our bank members share is they have a passion to serve their communities and their clients and their shareholders, and I know that's a passion that all of you share as well. We also have a lot of affiliate members, and Spectraform is one of our affiliate members. I'm happy to see them here today. But we have probably 125 affiliate members that serve the banking industry. These are companies that provide services to the banking industry, whether they be check printers, armored car services, accountants, attorneys, core data processors, you name it. And our mission is to try and bring the very best in services to our membership. The primary services that we offer to our members, I'd say first and foremost would be advocacy. You know, New Jersey is a very active legislative state. It's a very consumer activist state, and it's important that the banking industry have representation in Trenton to protect our interests so our industry can continue to serve our clients and our shareholders. We also work very closely with the ABA in serving our members and our industry in Washington. We do a lot of education and professional development. Literally, we probably have over 100 courses that we offer each year, ranging from every subject from compliance to Bank Secrecy Act to commercial lending training to teller training to trust and wealth management. Anything you can think of, we offer training. Some cases it's webinars that you can do online. Other cases it might be a 1 or 2 hour program, and in some cases it's a 2 or 3 day program. So that's one of our important missions. We also do offer a lot of networking opportunities, and I think that's probably what's held this group together over the years is the thing you value more than anything else. It's great to bring in speakers on interesting topics, but I think you probably get more benefit from interacting with each other and sharing, what's going on in the marketplace, best practices, things of that sort. So we try to do events that help bring bankers together so they can do that. And then the final thing we do is we have a for-profit subsidiary that offers services to our banking members, mostly on the employee benefits side. So our bank members can get health insurance, dental, long-term vision care, and all that kind of stuff. I'd say from a New Jersey Bankers perspective, if I gave you one message, I would just ask you to get involved, and it's great to see you involved with the Bank Marketing Network. But I feel like people don't leverage New Jersey Bankers for as much as we have to offer. And I think we're working real hard to bring you a lot of quality and value-added programs. So I would encourage you to try to get involved, whether you attend an event, serve on a committee, just visit our website. I will tell you we're going to launch a new weekly email newsletter sometime in January, and it's going to be a real easy read. It'll be a one-pager so that you can go to that email newsletter, open it up, and I know how many emails everybody gets, and it'll tell you everything you need to know about what's going on at New Jersey Bankers and really what's going on in the New Jersey banking industry. And if you want more information, you'll be able to click on that and find out about legislative issues or programs coming up, what have you. We're also going to be sometime probably in the first quarter of next year launching an on-site career center on our website so we can bring bankers that are looking for positions together with banks that have opportunities, and that's something that we're kind of excited about as well. But please get involved. If you want to give me your business card before I leave this morning, I'd love to put you on our distribution list so you get our email newsletter and you get our magazine, which comes out quarterly. Now what I'd like to do, since I finished my little commercial for New Jersey Bankers, is I'd like to share a presentation with you that I gave a few months ago in October to the Princeton Regional Chamber of Commerce, and that's when I met Jane and how she identified me to be your speaker here today. My disclaimer right up front, though, is I'm not an economist. Dr. Seneca has left the room, and that's probably a good thing because he relies on a lot of data and facts. I have some facts, but I have a lot of anecdotal things that I like to use as well. My perspective is really one from someone who's been a banker for 28 years and who gets up every morning and goes to work each day representing New Jersey's banking industry. So I have lunch, breakfast, dinner with bankers, and I'm talking with bankers all the time. So I think I've picked up a few things along the way, and I can share some of their perspective. The topic I have today is financially turbulent times in the state of New Jersey's banking industry. I'd like to cover 3 subjects. First, I'd also like to talk about the subprime issue. I didn't compare notes with Dr. Seneca, but he spent some time on that. It's obviously a very important issue these days. I don't know if Peter Crowley's going to touch on it in his comments. Fortunately, probably not. but how this problem arose, where we are today, and what I think may happen next. Next, I'd like to share some comments and statistics with you about the state of New Jersey's banking industry. I personally feel there's never been a better time to be a consumer customer, a small business customer, or a corporate customer of a bank, because the availability of products and services and the competition has never been greater. And then lastly, I'll talk a little bit about the importance of financial literacy and why I think we all need to get involved in that. First, on the subprime issue, when I gave this talk a few months ago, I went into the definition of the word turbulence, since I titled my presentation Financially Turbulent Times. I shared definitions for the word, and I quoted Alan Greenspan from his book that he recently released, which is The Age of Turbulence. But in the interest of time, I'll spare you the quotes and the definitions. But I think all of you would agree we certainly live in very turbulent times. All you need to do is pick up the paper each morning. Something I like to do is turn on CNBC. I have satellite radio in my car because I'm in it so much, and I listen to CNBC every day. And from morning to afternoon, things change so dramatically. Or the other thing you can do to know that we're in turbulent times is check your 401k balance every day, and you see it go up and down. And some days you feel like you're on the verge of retirement, and other days you think that it's years away. But there's no question we live in turbulent times, and arguably the issue that has created more turbulence than any other is the issue of subprime mortgages. It's affected Wall Street, it's affected Main Street. We've seen some of Wall Street's largest firms and some of America's largest banks declare major write-downs, multi-billion-dollar write-downs, and there's more coming. I think the end of this quarter we'll see a lot more in the way of those write-downs, and probably for another couple of quarters. We've seen CEOs of major companies, powerhouses like Citibank and Merrill Lynch, get let go within the same week, which is, I think, unprecedented. We've seen hundreds, probably thousands of mortgage brokers go out of business and mortgage companies go out of business. I don't know that that's necessarily a bad thing. I think it creates a great opportunity for the banking industry, especially America's community banks, because I think we can fill the void of what they were doing. As we heard Dr. Seneca say, this is a global issue. When you hear about, I think he said, towns in Norway that couldn't pay their bills because they bought subprime paper here in the U.S., it's pretty amazing how we are connected globally. But I think the most important impact is the one that it's having on American homeowners. And literally millions of Americans could lose their homes because they have mortgages that are adjustable rate mortgages. They can't afford their payments. The value of their house has gone down. And they're in mortgages that are very restrictive as far as prepaying them or allowing them to restructure. To provide some context on the mortgage market, you should know that 35% of all homeowners in the United States do not have a mortgage. They're free and clear. And of those with mortgages, 94% are paying on time. So really the problem lies within the subprime market, and that's about 14% of the total market. And of the subprime market, 85% of borrowers are paying on time. So you're looking at a 15% delinquency rate that is growing. For those of you who don't know what a subprime mortgage is, and you probably do because we've read about it for months and months, but basically it's a mortgage to an individual who probably otherwise wouldn't have qualified for that mortgage because they didn't have a satisfactory credit. So they're able to get a mortgage, but because of their poor credit history, they did pay a higher interest rate. That's the good news. They get the mortgage, they can pay a higher interest rate, but it did put people into homes. Between 1994 and 2003, this has been going on for a long time, going back to 94 to 2003, subprime lending grew at a rate of 25% a year, which is a very significant growth rate. I have a few slides I'd like to share with you. You can see from this slide, subprime mortgages for the period of 2003 to 2006 grew as well. And it's becoming a very big segment of the total mortgage market. In fact, according to the Mortgage Bankers Association, in 2006, 19% of all mortgages were done on a subprime basis. As I said earlier, it's not all bad. It did allow a lot of people who otherwise would not have qualified for a home purchase their first home. And as I said a few minutes ago, 85% of subprime borrowers are paying on time. It's the 15% that aren't paying on time that's creating all the problems. Home ownership rate in the United States has reached a record level of 70%. But the truth is, that said, many subprime borrowers were put in adjustable rate mortgages that they simply couldn't afford. They were given an initially low teaser rate, which enticed them into the product, but they weren't underwritten based upon what the rate was going to convert to. And anybody who has good credit underwriting skills knows you have to underwrite the loan to ultimately what those payments are going to be. So now they have loans they can't afford. They made, in most cases, very little down payments. As the housing market has declined, now they're well above 100% loan to value. And a lot of times the income and employment verification standards were relaxed. I think it's important to note that for the most part, these subprime mortgages were not done through the nation's banking system, commercial banks or savings banks. And I just wanted to share a quote with you from Barney Frank, who is a congressman from Massachusetts. He's the chairman of the House Financial Services Committee. He's a very powerful man in Washington. He recently did an op-ed in the Boston Globe, and this was his quote. He said, "At every step in the process, from loan origination through the issue of exotic, unsuitable mortgages to the sale of securities backed by those mortgages, the largely unregulated, uninsured firms have created the problems, while the regulated and FDIC-insured banks and savings institutions have not." You can talk to a lot of banks in New Jersey and you bring up subprime, and early on everybody would say, well, what's the big fuss about? I don't have any of those on my balance sheet. These loans didn't go through the traditional banking system. People didn't walk down the street to the corner branch and apply for a mortgage at their bank. The application was taken by a mortgage broker, many of whom are reputable, but many of whom get paid by collecting the fees when that mortgage closes. It was funded through a mortgage company. The loans were packaged on Wall Street. Rating agencies provided ratings on this paper, which I don't think they really understood the quality of, and then they were sold to investors literally all over the world. So that's why you have towns in Norway that have this paper. So it is really quite a mess. Here you can see the delinquency statistics for the second quarter of 2007, and you can see how the delinquency rate for subprime adjustable rate mortgages was at 12.4%. I think it's probably closer to 15 today, but it's dramatically higher than the other mortgage products, certainly a lot higher than the prime fixed rate or the prime adjustable rate products. This will show the change in delinquent subprime loans across the country, and it breaks it down by state. And you can see that New Jersey, if you can see it okay, is one of the states that's had a dramatic increase in the delinquency of subprime loans, up over 50 basis points during that period between the fourth quarter of 2007 and the first quarter of 2007. Dr. Seneca mentioned foreclosures earlier. This slide talks a little bit about the change in subprime loan foreclosure starts. Again, New Jersey is one of the states that's experienced a larger increase in subprime foreclosures. We're in the 21 to 40 basis point range for that same period of Q4 of 06 to Q1 of 07. Nationally, I read in the paper today that the foreclosures through the end of October for this year were 1.8 million versus 1.3 million through October of 06. So a dramatic increase. And I've heard statistics that in New Jersey alone there are over 20,000 foreclosures in process. That doesn't mean they're all at the end of the process where they're going to be foreclosed, but nonetheless, the point is a lot of homeowners are in serious trouble, and a lot of these loans were made in low to moderate income areas for first-time home buyers, so it's a very serious concern. This is kind of telling, and this talks about the adjustable rate subprime loans and how the rates are going to be reset. And you can see we're going to be dealing with these rate adjustments well into 2008, and that's why we haven't seen the end of the problem yet. Through the third quarter of next year, there's a large percentage of these subprime loans that are going to have their rates reset. This is even scarier. This talks about how much their rates will be adjusted. And this slide basically indicates that 41% of these adjustable rate subprime borrowers will see their interest rate on their mortgage go up by more than 100%. You can imagine what that would do to your monthly budget. I know what it would do to mine. So it's a very serious concern. It's estimated right now there are 2 million foreclosures in process throughout the United States. And lastly, Dr. Seneca again talked a little bit about the housing inventory, but this is a slide that shows the inventory of new homes inventory, and you can see it's somewhere in the neighborhood of 8 months of new homes housing inventory that's out there, and how that is so much higher than it was just 10 years ago. It's a dramatic increase. Again, imagine what all these potential foreclosures coming on the marketplace are going to do to that. statistics. So it's having quite an impact on the housing market. So where do we go from here with subprime? I personally think we are starting to see some positive things regarding subprime, some positive developments anyway. Dr. Seneca referred earlier to the efforts in Washington, and I know there are mixed views on this subject, but the Bush administration, through the Treasury Department, Secretary Paulson, the FDIC, the OCC, and a lot of the lenders and investors that hold these mortgages are very close to reaching an agreement. I think there's going to be a press conference today that for subprime borrowers who took out their mortgage from January 1st of 2005 through July of 2006, if they are current, they will have their teaser rate fixed before it adjusts for a period of 5 years, is what I read in the paper today. I think that's a significant help to these homeowners not to be facing their rates being adjusted, and it should help them stay in those homes. It's for only owner-occupied homes, which I think is important. Clearly, a lot of people, or some segment of the borrowers that got hurt by this adjustable rate subprime product were speculators, and I don't think anybody has any sympathy for them, so they're not eligible for this. Secondly, in New Jersey, just a month or so ago, through the efforts of the Department of Banking, Commissioner Goldman, New Jersey announced a new program called New Jersey Hope. And it's a cooperative effort between the State Department of Banking and the major trade groups in the state of New Jersey Bankers, League of Community Bankers, the Credit Union League, and also the Mortgage Bankers Association, as well as some other state departments and some not-for-profit credit counselors. And the whole idea is to get the word out to homeowners who may be at risk of slipping into delinquency, to contact any of those groups I mentioned and seek guidance. The Bankers Association, along with the League of Community Bankers, people contact us, we'll put them in touch with our member banks to see if they may be candidates to be refinanced. If they aren't candidates for refinancing, their credit has already deteriorated, we have credit counselors that we can put them in touch with. So I think that's a positive development here in New Jersey. New Jersey is clearly not as hard hit as some of the other states. The worst states are Florida and Arizona and Ohio. And then finally, I think what's happening in the marketplace, the market itself is forcing a lot of the major financial services firms to come clean with the bad paper that they have. So that's why I think, in addition to all the billions in write-downs you're already seeing, by the end of this year, a lot of them are saying it's the kitchen sink theory, but a lot of these large companies are going to clean out their balance sheets and declare the write-downs that they should. I think we're going to continue to deal with the subprime problem well into 2008, probably into the second or third quarter. I think the financial markets will obviously recover. I think the credit markets are starting to recover. I think the major concern here is homeowners, and hopefully not too many more homeowners will have their homes foreclosed. But the reality is many of them are already delinquent on their loans, and they're not going to be eligible for refinancing. I do think this will have a continued drag on the housing market and the economy overall. I'm going to switch gears for. Need some help. All right, I need some technical assistance. Yeah. Okay, thank you. I may need you to do that. But I'd like to talk a little bit about the state of New Jersey's banking industry now, something near and dear to all our hearts. I think if there is a silver lining to the subprime issue, it's that the banking industry is very strong. It's coming out of a period of time, but up 5 years ended in 2005, where the industry had record profits. Really, in 2006 was the first time we started to see a little bit of deterioration in bank earnings. But FDIC-insured institutions, savings banks and commercial banks, have strong balance sheets. They have good liquidity. That's starting to be challenged a little bit. But I think they're in a good position to help the nation's consumers and small businesses and corporations work through this crisis. This slide just shows how much the industry has grown. You can see in the 10 years ended in 2006, the size of assets within the banking industry, these are FDIC-insured institutions, it's up to $12 trillion, which is a dramatic increase from just 10 years earlier. And even more noteworthy is how profitable the industry has been. In 2006, $146 billion in net income. That's a 180% increase over 10 years earlier. This has led the industry to have very strong capital and good loan quality. And you can see capital assets ratio, one of the measures the industry uses. At the end of 2006, it was 10.5%, up very dramatically from 1996. And loan quality at the end of 2006, delinquencies of only 1%. I do get feedback now anecdotally from bankers that I talk to that they're beginning to see some deterioration in their loan quality. Nothing dramatic yet, but there is some slippage, and I think that's directly related to the slowdown in the economy. The other major trend that's happening in banking is the consolidation. And this slide shows the change in the number of banks within the industry for the period of 1995 to 2006. Again, you can see the asset size of FDIC-insured institutions has grown dramatically from 5.4 trillion up to 11.9 trillion. You can see that the number of branches has also grown dramatically, about 81,095, almost 95,000 branches in 2006 year end. We've seen that in New Jersey for sure. I think Commerce Bank obviously was very aggressive with their branching strategy, and you can't drive around the state of New Jersey now and go to any major intersection without seeing a bank on most of the corners. Are there some opportunities for further branching? Perhaps, but I think we must be getting somewhere close to that saturation point. But the big factor here is the number of institutions has changed dramatically. So while the size of the industry has grown, our distribution network has grown, number of institutions is down 27% from 1995. We had almost 12,000 FDIC-insured banks back in 95. We're down to 8,700. Just recently here in New Jersey in the past year, a few weeks ago, Oratani Savings Bank announced that they're acquiring Greater Community Bank, a savings bank acquiring a commercial bank. I think we may see more of that because savings banks, a lot of them have a lot of excess capital. In the fall this year, TD Bank North, headquartered in Toronto, as we all know, announced that it's acquiring Commerce Bank. And I know we have some colleagues from Commerce here today. That's a deal that's moving along. We'll probably close in the first or second quarter of next year. A very attractive acquisition for TD Bank North. But I think also what's happening with the dollar helped contribute to that a little bit. I've heard estimates that the lower dollar value can give foreign banks a discount of anywhere between maybe 15 and 30% on the acquisition of an American bank. So I think that's a trend we'll see more of. And then earlier this year, PNC Bank announced they're acquiring Yardville Bank. Yardville is a $3 billion institution here in New Jersey. It's a large bank, but being acquired by PNC, and that deal's going to close probably by year end. So what's driving this trend towards consolidation? I think more than anything else, it's earnings pressure. Banks, both large and small, are under pressure from their shareholders, and they're under pressure from the marketplace to deliver earnings growth, and that's been very difficult to do over these past few years. I have a few slides that will illustrate that. This is, again, New Jersey FDIC institutions, and it's you see the median return on assets back in 2005 was 0.78. At the end of the second quarter of this year, it declined to 0.42, which is a pretty significant decline. And again, this is the median, so half of the banks are obviously below that level. Also, you see the median net interest margin, difference between what we pay for our funds and what we lend them out at. It's gone from 3.36 to 3.14. So that's created a lot of pressure on banks' earnings. I don't have to tell any of you how hard it is to generate deposits. I'm sure that as your marketing officers of banks, you're trying to always come up with creative ways to bring in new deposits, to segment the market and all that, other than just through price competition, which seems like what we experience quite a bit now. This slide talks about the summary of statistics here for state-chartered banks, thrifts, and credit unions. You'll note that in absolute dollars, net income is down significantly for these state-chartered institutions, over $231 million. I think this is a little distorted by the fact that there have been acquisitions of state-chartered banks by large national banks, but clearly there has been a decline in the profitability of the banks. This one will be a little more targeted. It talks about annualized net income as a percentage of total assets. and you can see what's happened here from '07 to '05, a decline of almost 50 basis points, with most of that occurring in the commercial banking segment and to a lesser extent on the savings and loan side, and there aren't as many savings and loans around anymore. But the commercial banks are experiencing margin pressure, and it's having an impact on their earnings. I think this decline in profitability, decline in earnings is being driven by the intense competition. The net interest margins, we've been through a period of time with an inverted yield curve where the short-term rates were higher than long-term rates. Some banks got caught up in that where they had long-term assets being funded by short-term liabilities. And I think as the economy softens, particularly the housing market, perhaps the commercial housing market, you're going to see this intense margin pressure and the pressure on earnings growth continue. My own view is that I think you're going to see continued consolidation of the industry. We saw what happened over the last 10 years. I don't see those trends changing. I think that we'll continue to see very, very large mega banks nationally, and I think there's always going to be a place for well-run local community banks. I think the banks that are in between are the ones that are going to be challenged for survival because they're not big enough to realize some of the economies of scale that the big guys have, and they're not lean and mean enough as some of the local community banks are to survive and prosper. So I think the consolidation of the industry will continue. An interesting phenomenon, though, is while we see all this consolidation taking place, you still see a lot of new banks or de novos open their doors. And Peter Crowley is going to tell us a little bit about that with his bank, Bank of Princeton. But in 2006, there were 191 new charters nationally, and that's been growing steadily every year since 2000. Here in New Jersey, we saw 14 new institutions in 2007. That was up from 10 in 2006 and up from 7 in 2005. So while the industry is consolidating and institutions are getting larger, there's still this phenomenon in local communities where you have local business leaders or community leaders who feel they need a local community bank to serve the community. There's still lots of capital out there. People have money to invest. There's a supply of bankers who have worked for institutions that have been merged or acquired who are very talented and they're not ready to retire yet, so you have management talent. And these banks are being formed. And there's also this belief that community banks can compete effectively against the big guys by being more local, by delivering faster and better service. So I think that the competition is great, and I think that the banks that are going to survive are the ones who are the most efficient and understand their customers best. I said earlier in my comments, I don't think there's ever been a better time to be a customer of a bank, whether you're a consumer, a small business, or a corporation. Pricing is extremely competitive. I don't have to tell you that. The focus on customer satisfaction has never been better. I know all banks are very focused like a laser on making sure the quality of their service is better than their competition. There's more convenient branch locations than there's ever been before. There's more convenient branch hours than there's ever been before. Technology is bringing new solutions to the marketplace. Remote deposit services has kind of changed the landscape for small businesses. They don't have to leave their office anymore to make the deposit at their local bank. So maybe you don't need a branch in that community where that small business is located to do business with them. Mobile banking services, you're hearing more and more about that, where customers can call up on their cell phone and either check their balance or transfer funds. Earlier this week, Bank of America announced that it launched its mobile banking service 6 months ago, and they now have 500,000 active customers that are calling in on a daily basis. Steve Lebecken raised his hand. He said he's one of them. So the availability of service has never been greater. And even on the large corporate side, the services there with sophisticated cash management and treasury services is tremendous. Finally, the people you're dealing with are more capable than they've ever been before. We spend more money on training than we ever have before. It's a huge investment, but we're trying to put in front of our clients the very best people in the market. So I think to sum up the banking side of it, we work in a very strong industry here in New Jersey. The banks are coming into a softer economy with strong balance sheets, very good loan portfolios. I think we'll experience some deterioration in both perhaps this year, perhaps into next year. But I think there's great opportunities being created by the changes in the marketplace. And I think that the combination of the mergers taking place with out-of-state banks coming in to acquire local banks and so forth, and the mortgage industry changes, I think there's great opportunities for our banks. So I think your jobs as marketing officers are going to become even more challenging if that's possible, but they'll be more rewarding as well. Finally, just a comment on financial literacy. I think our country has major problems with financial literacy, our society, and I do think it's having a negative impact on our economy. Our nation's savings rate is very low because I think we've gone through a generation of children, perhaps our children, that don't really have an appreciation for the importance of savings like perhaps we did, or certainly our parents' generation. In 1990, the nation's personal savings rate was 7%. It declined to 2% in 2004, and in August of this year it was 0.7%. And that's the savings rate as a percentage of disposable personal income. Some people would say that, well, more people save now through their 401k plan, so it's not really apples to apples, and that's true. But clearly the nation's savings rate has declined. That's part of the reason we're seeing all this investment from outside the U.S. We have young adults and college students who can't balance a checkbook, they can't manage a credit card, they don't understand the importance of maintaining a good credit rating. We have an exploding immigrant population here in New Jersey. I think it creates a great opportunity for the banks that can figure out how to serve those segments. But a lot of these new immigrants to New Jersey and to our country haven't even entered the banking system. They're using check cashing services. They're not in the traditional banking system. And I'm sure it's a huge number that represents that part of the economy. And we have senior citizens every day that continue to fall prey to financial predators that are trying to, steal their life savings away from them. So no question the subprime mortgage problem wouldn't have been as bad if consumers had been better educated about the products they were getting into. And yes, a lot of these consumers were first-time home buyers, so maybe they didn't understand it. But there's a segment of people with subprime mortgages that are very affluent, very successful in their own careers, but they didn't take the time or they weren't educated about what kind of products they were getting into. So it's a very big issue, financial literacy. I think all of us have a responsibility to try and address it. And I think we'll all benefit from a stronger economy that will result from more educated citizens. There's a number of great programs that have been launched at the federal level. The ABA has been a great champion of financial literacy, and I know back in October it was Credit Awareness Day, and across the country hundreds and thousands of bankers visited local high schools to talk about credit services. Here in New Jersey, October was Financial Literacy Month. I think the state's going to do it again in April. 200 high schools this past October were visited by bankers who volunteered a couple hours of their time, and they went into the local high schools and talked about products and services. I know a lot of the banks have done things with local grammar schools to try and promote savings. So I think it's an important issue, and I mention it in closing only because I think to the extent that as an industry we can do a better job of educating the public, we'll all benefit by having more customers and more business. And with that, I'll wrap it up. I'll thank Jane for the opportunity to speak here, and if anyone has any questions, I'll be happy to entertain them.
John, I had to ask you one.
Be nice.
You mentioned throughout your presentation saturation of branches, potentially with every major corner having a bank, direct banking through the internet for consumer, and now the remote deposit capture for the small business. Where do you see branching in New Jersey going forward, especially with Citi and Chase paying exorbitant what we would consider exorbitant prices for branching, maybe not compared to New York pricing, but at least in New Jersey, especially now that Commerce is out of business of branching?
I have to be careful because mostly all those banks are members of ours, so I don't want to criticize their strategy. But I think there's always going to be a place for the branch, and I give Commerce a lot of credit for having the courage at the time to go against the tide and build bricks and mortar when everyone else was cutting back. So I do think there's always going to be a place for the branch, and consumers, small businesses will need to go in and conduct business on a face-to-face basis. But I personally, this is not the official stance of the association, I think we are over-branched, and I think as we consolidate and you have larger institutions buying smaller institutions, they're going to look at these branch networks, and some of these are not going to make the cut in terms of meeting the profitability thresholds. So I think at some point in the next couple of years, you're going to see it subside and probably start to level off. What do you think? You work for a large bank in New Jersey? Oh, seriously?
I feel very similar.
Yeah. Yes.
Once banks stop thinking of themselves as just big boxes that hold money, and they possibly use their branch locations for peripheral services that deal with customer service, like financial literacy training, they have to bring people into their branches. And you can't use a 5% interest rate as the only way to bring somebody into a branch. So I think the bank philosophy has to change what they use a branch for.
Yeah, and that's a great point. I think a lot of the community banks that I've visited with recently are doing that type of thing. They're trying to make the branch part of the community, and they make the conference room available to the local not-for-profit to come in and have their meetings, and it makes it a more focal point of the community, not just a box, as you said.
Any other questions?
All right. Thank you very much.
We're just going to take a minute to change computers, and we'll start with our third.
We hope you enjoyed this presentation by the New Jersey Bank Marketing Association. If you have comments or suggestions about these video podcasts, please send us an email. The address is steve@professionalpodcasts.com. You can also send us an audio comment by calling 856-861-6146. We produce these programs in the studios of Professional Podcasts in Cherry Hill, New Jersey. For the New Jersey Bank Marketing Association, this is Steve Lubetkin. Thank you for joining us, and take good care.